A new YieldMax challenger has appeared. YieldBoost, a set of monthly dividend ETFs, recently started trading. Are they better than YieldMax? This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. Currently, the tickers in this lineup are TQQY, YSPY, and TSYY. They each use the same strategy but on different reference stocks. Their goal is to use an options trading strategy to provide monthly dividends. Here's how. When you invest your cash in these ETFs, they buy short-term treasury bonds to park the money in something low risk with interest, albeit little. They use those bonds as collateral to sell in-the-money puts against the stock or ETF they trade against. They can also elect to do a put spread instead of just selling puts as a means of reducing potential losses. The profits from this strategy are how they pay for the 1.07% fee and the monthly dividend. These ETFs live and die based on their reference stocks, so we'll start with each of the ones they trade already. TQQY trades this strategy against TQQQ, a 3x leveraged ETF that trades against the NASDAQ. That 3x leverage means TQQQ moves in the same direction as the NASDAQ, but with 3x the movement. So if the NASDAQ goes up by 1%, TQQQ goes up by 3. If the index goes down by 1%, TQQQ goes down by 3. Trading against this leveraged ETF as opposed to the NASDAQ directly increases the volatility for their sold puts, which increases premiums. While this means potentially higher income per contract and therefore more dividends, it can also easily backfire on bad days. Selling in the money puts means this ETF starts off with the risk of being assigned, which would incur a loss. If they choose to do a put spread instead, that doesn't reduce the risk of a loss. It only reduces how much they could lose on this position. YSPY does this strategy on the SPXL ETF, another 3x leverage ETF, but this one trades against the S&P 500. Just like TQQY, this ETF also incurs the same super high risk with the hope of a higher payoff per contract. TSYY trades against TSLL, a 2x leverage ETF that trades against Tesla stock. Unlike the other two ETFs, this one only takes on twice the risk of the underlying stock, although Tesla isn't exactly low risk itself. Tesla stock has been known to fluctuate wildly throughout the year and based on sentiment for or against Elon Musk. So while this sounds on paper like slightly lower risk, this is at its core a single volatile stock without the buffer of a whole index traded at 2x leverage. TQQY and YSPY are still brand new, so let's check out the returns on TSYY first and see if this strategy performs well. As of March 26, 2025, TSYY's total return is negative 26.99% since inception. YSPY is also currently down 7.41% since inception, and TQQY is also down 11.41% since its inception. What do you think? Are these ETFs worth buying? Tell us in the comments below. If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.